So welcome everyone. This is the maiden voyage of a new endeavor Lexington's beginning to roll out, and that's periodic conversations around markets and market volatility. So please excuse any technical difficulties in the background. I'm in my office here in Lexington, Massachusetts, and there is some construction going on the street behind, so please forgive any background noise. So I'll do a quick intro of me, then I'll let Brad do an intro of himself, and then we'll take it from there. My name is Mike Tucci. I'm the CEO and co-founder of Lexington Wealth Management. I've been at this at Lexington for about pushing 20 some odd years. And in a previous life, I was a CPA with one of the international firms, then my own firm. And we got Lexington going about 20 years ago. And back in the day, there was only 2 or 3 of us. And we've since grown to pushing 30 people and $2+ billion under advisement. And I'd like to think we're doing a lot of great things for a lot of really great people, our clients, and we've built a wonderful team. Lexington has always been a firm seeking out best of breed in everything we do. And by that, what I mean is that we do a lot of things really well here in-house, but we always seek out extra expertise in areas so we can bring the absolute best to the table. And with that, we have partnered since we've been in business, in addition to our internal investment committee, which we'll discuss in a minute, with external firms. And the firm we've worked with for several years now is a firm called Fiducient out of Chicago. And they are an absolute top-notch research group. They really augment the work that our investment committee does. And they really have insight to, they advise on billions and billions of dollars with many clients and been around for a very long time. So we really like the depth of research that they've really provided to us for several years now, and they've done a great job with us. And it does augment the work of our investment committee. If we go back and look at the slide of our team members in the investment committee, you'll notice alphabet soup of the people involved there. And there's many others that are highly involved that I'm on this photo right here. But that group is a really hard-working group that meets on a monthly basis, and we meet with Fiduciant on an ongoing basis. So with that, I'm going to turn it over to Brad for a sec, and for just to talk a little bit about his background, and then we'll jump into the meat of the presentation.
Sure. So Mike, thanks for having us. So as Mike mentioned, I'm Brad Long. I'm a partner and Deputy Chief Investment Officer at Fiducia Advisors. We're a $260 billion plus consultancy that's been around for 20+ years. I assist and help lead our team of research professionals. We have over 20 dedicated research professionals, industry experience, about 12 years on average of industry experience. And so a really deep, broad group that's able to augment a lot of the great work that Mike and team does. So looking forward to the discussion. There's certainly no shortage of things to talk about.
So this will be more of a discussion, right? And this is something I seem to do every day. And I've got notes, which I'm sure I will not use one of the notes I have in front of me, maybe 1 or 2, and we'll just chat. And I think clients will benefit. So today is June 15th. And at 2 o'clock today, the Fed is supposed to come out with its next comment on interest rates. So I think a part of what we'll discuss today will be stale within days or weeks. And part of what we'll discuss today, I think, are enduring thoughts and lessons that we could probably bring up in a year, 2, 3, 5 years that would still prevail. So I actually am an intellectually curious person. So I and the firm tends to triangulate on everything, right, in terms of looking at things. And I have a piece in front of me that Liz Ann Saunders, she's the chief strategist at Charles Schwab. It's one of the firms that we use. And I know you use, Brad. She wrote a piece recently and says, panic is not a strategy, nor is greed, right? And she starts off, if markets are good at one thing, it's reminding investors that stock prices don't simply go up uninterrupted forever. We do not have a crystal ball, and there's not a bell that rings at market tops and market bottoms. What we do know, we don't know the stream of market returns, but what does matter is that we do the right thing along the way. Essentially, I'm paraphrasing, right? And I think what today's call is about is trying to have a reasonable discussion, inform our clients and friends of the firm, and then for us to do the right thing along the way. Because our only goal is to get our clients to their ultimate goals. And we actually really don't care how we get them there within reason, right? But we want to make sure that they reach those goals. So In traditional parlance, right, in our field, the classic portfolio is what people call a 60-40 portfolio. 60% stocks, 40% bonds. And in the real world, clients' allocations will differ quite a bit. And stocks aren't always stocks anymore. They're things stocks and stock-like, and bonds aren't always bonds. They're bonds and bond-like. But that's the starting point for most conversations around investing. And thus far this year, the 60 hasn't worked out so well, and neither has the 40. So I'm hoping we can just go into a little bit. We'll start with just what's happened approximately so far this year, and then maybe do some macro conversation around markets and the economy, some micro, and then talk about portfolios, some implications, some things we did prior to this pullback, and what we might be thinking about going forward. Does that work for you?
That works perfectly.
Okay. So I'm going to turn it over to you. Let's just discuss, so in summary form, what's happened so far year to date. And by the way, we expect to be doing this for anywhere from 30 to 40 minutes today. We'll leave it open-ended and just see where the conversation flows.
Great. Yeah, so look, I don't think it's new news to anyone that it's been a rocky road year to date. When you think about typical corrections or even bear markets, right, usually defined as down 10% or more or 20% or more, in the latter category, a bear market, recent history, bear markets have really been induced by something exogenous. So that was COVID in 2000. It was the financial system in the great financial crisis in 2008, 2009. It was the tech bubble in 99 and 2000, right? So we've come to expect bear markets to be led by this kind of external force that drives markets down and sentiment down and unemployment up, et cetera. Mm-hmm. This year, volatility has been driven by something different, and it's really been driven by a word that's almost fallen out of the lexicon of investors, which is inflation. And so inflation has taken root, and we can talk about kind of how deeply it's taken root. And then because of that, the Fed has really been put in a hard position. They're trying to tame inflation. They have a dual mandate of full employment and price stability, the latter of which they've been suffering on, and inflation has been running. And so the Fed has been doing something they don't really want to do. They've been raising interest rates, which cool the economy in an environment in which the economy is already cooling and the market is already fidgety. And so when we think about, usually stocks and bonds aren't down kind of at the same time. In recent history, it usually looks something like if equities are down 20%, bonds would be up 5 or 7%. But the source of volatility this time has really been led by inflation and by extension, the Fed, which has pushed us into this environment in which that has an acute effect on fixed income, right? As the Fed raises interest rates go up, that means existing bond prices fall. But by extension, it also has an impact on the equity market. And so while not unprecedented that equity and fixed have fallen at the same time, it's unusual, and especially given recent history, meaning dating back to the 80s, 90s, and 2000s, we have to look back to a period in which, like the 1980s, the 80, 81 recessions, where that was Paul Volcker raising interest rates materially to break inflation, where you saw stocks and bonds come down kind of in the same, at the same rate. And so while it feels a little different, and it is frankly different than recent history, it's not unprecedented, and frankly, it's somewhat understood given the context of where we started the year and where we came from, and why we've seen both the 60 and the 40 fall in concert with one another.
Sure. So when we break out different asset classes within equities, I know there's an attached chart, I think, for the presentation, to the conversation, I should say, which goes into various asset classes, what they've done so far this year. There are very few asset classes that have done well, right? Why don't we discuss a little bit of the ones that have done well so far this year?
Yeah, won't take very long. So when you think about broad indices, right, there are certain parts of the market when you get into sectors or individual stocks that have certainly done well. But you can see on the screen here, below the line is a negative return, and we've got a lot of red on the screen. Broadly across fixed income has been underperforming based on increasing interest rates. That also extends into the gray bar here, which is equity markets globally. So that's in the US, international, emerging markets, et cetera. We really have to reach into the light blue where we start to see the big green numbers on the screen. So that would be things like commodities or energy infrastructure. There are a few things that aren't on the screen here. So things like floating rate fixed income has eked out kind of positive, barely positive returns this year when much of its cohorts have been down, or energy infrastructure or agriculture related businesses have done well. But by and large, there hasn't been a whole lot of places to hide. And because in big, broad, diversified indices, as you noted, Mike, in those 60s and 40s, they've largely been selling off in concert with one another.
Sure. Talk a little bit about fixed income. I think we have the following slide is on fixed income. And fixed income is usually the redhead stepchild, or the thing that's really boring and just people's eyes glaze over and they don't want to talk about. But stated positively, it's been an exciting year for fixed income. Not a good exciting, but a bad exciting. Talk about what's happened so far, where it may go, and the future positive implications for clients potentially.
Yeah, so we actually wrote a paper entitled Fixed Income Complacency towards the end of last year, to your exact point, Mike, just saying, hey, we've been in a secularly declining interest rate environment for 30 plus years. A lot of investors have kind of fallen asleep at the wheel when it comes to fixed income. They think of it as sleep at night. They think of it as duration risk, as a mythical creature that it will never appear its head, right? Mm-hmm. But now we've entered 2022 and reality has struck. So if we actually jump down to the next slide here, just to give a little bit of context is like, okay, well, what has this year looked like in comparison to other years in fixed income? And all of these lines here are global bonds over the last 30 years, since 1991. And, it shows the annual return. Clearly, one of these is different than the other, and that has been the year-to-date return in global bonds. Now, the increasing interest rates, that's a pretty self-evident reason of why bond prices have been falling. I think the question many investors are asking are, why is this line so sharp and so materially down relative to other periods? And that was part of what we were writing on fixed income complacency, is when you look at history as an analog to try to predict the future, in some instances that's really instructive, and in other instances it's not at all. Fixed income in this instance, we didn't think was very helpful to look at the past to try to judge what might happen in the future. The reason being is the forward-looking returns on fixed income are primarily driven by current interest rates. And so when we look over the past, and especially in rate rising cycles, which we've seen 8 rising cycles since the 1980s, through Greenspan and a quick period with Ben Bernanke, et cetera. The starting yield of fixed income in those periods was materially higher than it was when we started the beginning of the year, meaning they already had a head start to overcome what would be the headwind of rising interest rates. We didn't enjoy that benefit coming into this year. And so that has been one of the reasons that's predicated kind of that loss in fixed income. Now, if you look at, let's see, a couple slides forward, it's a slide entitled Short-Term Pain, Long-Term Gain. If we look at kind of the flip side of, wow, fixed income's been really painful. I thought this was sleep at night capital. How is it down so much? The main benefit here, though, is that higher yields, while that certainly hurt prices, absolutely improves forward-looking returns. So this graph is the last 30 years where we just simply overlay the US 10-year Treasury yield, so how much it's paying you, and the subsequent 10-year return of the Barclays Aggregate Bond Index, or Bloomberg Aggregate Bond Index, and they're very much interrelated with one another. So effectively, where my yield is my best predictor of future returns, and yields have doubled or more since the beginning of the year. So while it's been painful in a short period of time for fixed income, the outlook is consistently getting brighter and brighter for fixed income being able to provide a meaningful return going forward in portfolios. So there's a little bit of a bright spot there.
So I had lunch yesterday with a fixed income manager from JP Morgan, and his comment was fixed income is getting exciting again, and he was getting positively bullish. And everything from bar cap, a certain expected current rate, to even high yield is now really high yield again. Can you talk about that? And do you think it's time to get a little bit more excited about fixed income? Or if you had new money you were putting into the market, how comfortable would you feel in that area of the market?
Yeah. So why don't we jump to slide 14, I believe, the policymaker tightrope slide. I think this is actually just a good one more, actually two more maybe behind that. It's just a good depiction of, yeah, here we go. of where we kind of sit in markets today. So the Fed actually has done very little year to date. They've actually increased interest rates 3 times, so 3/4 of 1 percentage point. Last week, we started quantitative tightening, but not in a bang out way, right? But it's the market looking forward and predicting what is it the Fed's going to have to do to try to get inflation under control. And so the left graph here actually shows the Fed futures can show the market's best guess on where we'll end the year with interest rates. Now, these slides were actually built before the CPI print last Friday, and they've even shifted higher, meaning the market believes that the Fed's going to have to do even more to reduce inflation. Now, if you look at the right, if predictions become reality, and let's just use the example that's on the slide here, we would actually have 8 more rate hikes ahead of us between now and December of 2022. Now, that tells us 2 things. One is, the first thing is, we wouldn't expect 8 times the amount of pain going forward here in fixed income just because we've got 8 more rate hikes. The markets is very well aware of what the Fed is being forced to do, hence where prices have come off in fixed income. So this is kind of priced into markets.
So that's an excellent point. I mean, so the market is arguably forward-looking, right? So the Fed to date, I know there's a rate hike due out today again, but hasn't done all that much. And yet fixed income is repriced quite a bit. And that's in anticipation of what they're going to do. Is that correct?
Exactly right. It wouldn't be if the Fed raises 50 or 75 today and does so again in September, that you just have this incremental falling in prices, right? It's expectations relative to market prices. But what that does say to us, though, is that from here forward, from June forward, there's still a lot more wood to chop in the fixed income market. The Fed is going to be very active in increasing interest rates and decreasing its accommodative stance. Quantitative tightening is beginning, which is going to lower liquidity in fixed income. And spreads are beginning to widen because the market is fearful that the Fed is going to have to hike into a recession to actually get inflation under control. So
can you pause there for 1 sec?
Yeah.
So for a lot of our clients, explain what you mean when you say spreads are going to expand.
So it means when you buy a bond, it has a coupon. Let's say it's a 5% coupon.
Mm-hmm.
Well, bond prices move every day. So actually the yield is what you're going to get for it. So it has a 5% coupon. Let's say it has a 6% yield. Mm-hmm. Well, that yield is made up of that coupon and a couple of other things. Well, if spreads widen, that means the bond becomes more attractive. It's paying you more to own it. Now, spreads are also indicative of potential risk of default. So a high yield bond that would pay 6% at the beginning of the year and now pays 9%. It's because the market is betting that there's a higher likelihood that that bond might not be money good. And so in order to purchase it, they say you have to pay me more. There's more risk here. And so the clearing price becomes 9 or whatever the fair value is traded at. So for future returns, higher spreads, meaning higher yields, equals better opportunity. And my point on fixed income was that while there's still a lot of wood to chop, whether it's through monetary policy, quantitative tightening, or if the Fed actually does hike into a recession, which just has an impact on kind of credit markets broadly, the fixed income market is definitely more attractive than it was at the beginning of the year. But to your lunch yesterday on JP Morgan, is it just it's higher yields, let's just go ahead and back up the truck? It's not quite that simple. There's a little bit more in that narrative that we need to be aware of.
Mm-hmm. I agree. So we talked about bonds a little bit. Let's go back to equities and equity valuations, where they sit, how attractive they look. And I'm going to throw out one caveat. There are different camps from my perspective on the world. Some people totally lean on valuation in terms of whether it's a good time to buy or not. There's a very notable shop here in Boston that leans very heavily on valuations. Most say it's a factor, and it's one of many factors to look at, and don't look at it by itself. Would you agree with that assessment?
Yeah, there's a lot of different ways to cut valuations for sure.
Sure. But I do think it's worthwhile looking at valuations where they are today and where they've been historically, just from a frame of reference. Most people I know, well, when we look at it, where valuations have come down, and that most likely is probably a good thing for future financial planning when you're looking at projections when we run a Monte Carlo with a client and try to see the probability of hitting a return in the future. When valuations come down incrementally over time, that should mean future returns look better. So I'll throw it to you and get your comments.
Yeah, valuations. I mean, there's a lot of ways to look at valuations, but let's say the simple framework of price to earnings, which is the upper left graph here. You have two components: price, what are you paying for something, and what are you paying for, the earnings in aggregate of these different businesses. So they have revenue of what they've sold, they have expenses, you drop to the bottom line, what they earn is actually what they keep. Oversimplification, but that's kind of where that shakes. Price has definitely come down. There's no question about it. We're in a bear market in equity land here in the United States that's largely been led by kind of technology or high price securities. A lot of those businesses have sold off in a more meaningful way. The NASDAQ is down around 30. Goldman actually runs a profitless index. So companies that are made up in that index are businesses that don't have any earnings. And that index is down over 60% year to date. So there's no question prices have come down and things are more attractive. Now, your point, Mike, on on valuations, I think is a critical one. Looking at valuations as a catalyst, meaning, oh, I'm going to buy it now. They're not particularly predictive. That is not a good signal of, yep, it's the exact right time. Earnings over the long term or valuations over the long term are predictive, right? Buying something when it's cheap and selling it when it's expensive, the math makes intuitive sense to a lot of people on that. So the price side of earnings is unequivocally cheaper. If you look at the price to earnings where we sit today, on average, we're just below 10-year averages on the forward-looking price to earnings. Now, the caveat we would put in there, and this is a little nuanced, is the E, the denominator. Right now, earnings expectations are still fairly robust for 2022. In fact, full calendar year earnings expectations are around 10%. First quarter came in at about 9%, and that was robust. But in order to make up the rest of the year, second half of the year is probably going to have to come in at around 11% or more. That's going to be a pretty hard hurdle to hit. And so if the E starts shrinking when expectations are shrinking, that means that maybe we're not as cheap as we look on the board. So when things have definitely come down, there's no question about it, but there could be more room just based on that denominator. The final thing I would mention on that is when we think about periods of volatility like we're in today, there's no question about it. Rarely do things come down to average levels of price and just stop there, right? The markets, to your Lizanne Saunders point, right? They're great at building humility, but one of the ways they build humility is they go all the way to the top and things look super expensive and you're euphoric, or they go all the way to the bottom and you don't know if the sun will rise the next day, right? So when we think about kind of, not that we do not advocate at all for trying to time markets around valuations, but if you're trying to get a sense of kind of the cheapness of stocks, we would say usually things tend to roll through the average and end up a little bit lower than that.
Okay. So we talked a little about stocks, a little bit about bonds. We're getting a little more optimistic on bonds. I know some of our clients have been using some short-dated bonds, and yields are now meaningful, right? Yeah. So something exists there. So I think there's something to do with maybe clients who are sitting on cash or some portion of cash to get some yield without a lot of vol in fixed income. Let's toggle over right now for a moment to, and then we'll go macro for a second, then we'll jump into portfolios. Some alternative investments, without going crazy on alts. There's some private real estate, private debt, and so on and so forth. There are different vehicles out there, and they're not accessible to everyone, and we know all of that. I think they're interesting vehicles, and I think there's a place for them in a portfolio, but we don't see them as panaceas. Just because things don't mark to market every day doesn't mean that their value hasn't changed as well. I'll toggle it over to you. Just very broad brush thoughts in and around that area.
Yeah. Private markets have certainly been kind of the rage amongst investors. And in the last decade, if you think about the period we've been in, which has been very favorable for private markets, it's been very favorable for growth equities. It's really been minimal growth, right? Economic growth, minimum yields, not really much to do in fixed income, minimum volatility, but we've had maximum liquidity from the Fed. We've had very cheap cost of capital. We've had very accommodative policies, and that has overemphasized the benefit of some growth-oriented private markets like venture capital or others, early stage businesses. Same thing kind of on the growth side of the public markets. So that is to say that private and public markets, while they're different and they've got different parameters and liquidity, et cetera, they're not immune to what's going on in the market. The same benefits that were given to the public growth side of the market were given to the private side of the market as well. As those benefits erode, as the Fed increases interest rates and the cost of capital becomes cheaper, volatility is higher, investors are less willing to trade for liquidity, they're going to be impacted. Now, whether you see it every single day, like you trade a stock, you won't, because it marks at a different pace. But there's no question that they don't get to defy the laws of kind of economic gravity, if you will. They're just as impacted. It's just going to come and feel a little bit different because of the mechanism you see it.
Spend a couple of minutes, and you just have to solve all the problems of the world in the next 10 minutes. Let's talk about some macro forces. So we certainly have a lot of stuff to discuss, right? We've been hearing about supply chain issues, rising price of fuel, energy, the war in Ukraine, food shortages. You can go right down the list, right? Let's just broad brush. I know they all have an impact on everything we're looking at. What are your general thoughts? And pick a topic or two, and we'd just love to hear your thoughts.
Yeah. Even with just some of those that you mentioned there, right? There's a whole host of things that go into each of those, whether it's the energy markets, geopolitical risks, food scarcity in agriculture, kind of the regressive tax of inflation on consumers and their ability to spend. And it's one of the reasons that if we step back and we talk about like, what do we practically do with all of this, right? Mm-hmm. Inflation is one of those things that is infinitely complex. And our minds are really built for, linearly solving problems. And inflation in an exponentially complex world is hard to get right, both the level and the timing. It just is. Economists are classically bad at timing inflation. And the Fed has learned a lot of humility in kind of transitory conversations in 2021 and average inflation in targeting, et cetera. And now we sit here at a fairly persistent, almost 9% inflation. So we don't want to time inflation or make bets around inflation. We want to build allocations that recognize inflation is an important input and that it's going to impact asset prices. But if inflation is benign, and by the way, throughout history, most of the time it is. Most of the time it kind of lives between that, 2 to 4% range, and it's not doing a whole lot. But there are deflationary periods, there are inflationary periods. Building a portfolio that's resilient through those, I think, is the key without trying to time it. So that would be just kind of the punchline before we even get to the joke.
I agree, building that resilient portfolio. So go back for a moment. And what I think is frustrating for us and a lot of our clients is that we know inflation is increasing, and we're sitting in a period where our portfolios have actually gone down, right? And if we had all of our money sitting in cash, we'd be 9% poor just due to inflation. But when your money's in a portfolio, if the portfolio is down more than that, there's that frustration, and I think temptation for a lot of people to attempt to time markets, right? And I was just talking to a friend the other day, and he said, "So what do I do? What's the thing to invest in to beat inflation, like the magic bullet?" Right? And my comment was, in my view, there's not a magic bullet. It's about staying disciplined in the long run. Can we talk a little bit about how, and people that do what we do, that are, I think, good at what we do, our answer is, hey, we build good portfolios, we look at your financial planning, what you're trying to accomplish over time, we go back to the plan, we'll make some adjustments here and there along the way. We can talk about some of the things we've done in the past, but it's not all in, all out. I'm in cash, I'm back in equities, that sort of thing. Can we talk a little bit about why it's so difficult to try to time markets and do the like, and why we think over the long run you don't benefit by doing so?
Yeah. Timing markets, you got to get three things right, and you got to get all of them right. You got to get the sell right, you got to get the size right, and then you got to get the buy right on the way back in. And to do that, there's two things you need to know. You have to have the fact pattern of whatever the scenario is, and then you have to know how the market's going to react to that. And both of those things are difficult to do. So let me give you an analog. It's 2019 and it's December and we're sitting here and I'm like, hey, Mike, guess what? Next year, 350,000 people are going to die from an acronym we haven't heard of yet next year. Unemployment is going to be high. We're going to enter a recession, and we're going to be sheltering in place globally around the world. Now I've given you the advantage of actually having the right set of facts. Now the question is, what is the market going to do? Very few people would say, yeah, the S&P is going to be up 19%, right? So even if you could get all of those fact pattern right, then translating that into market reaction is extremely difficult to do. So that's why kind of that idea of market timing is so difficult. Now, the flip side of that is the cost of getting it wrong is also important. So what are you wagering? Or you're like, oh, I'm going to be in cash, or I'm going to be back to the market, or whatever the trade is, if you will. Well, if you look at the S&P since 1980, there's over 10,000 trading days since 1980 on the S&P 500. If you miss the best 5 days, just 5 days, you miss 45% of the total value you would have earned over that time period. That's an insane statistic, a small number of days. And most people think, oh, well, that's only 5 days. But those 5 days, 100% of those 5 days occurred during periods of volatility, like a recession or a bear market. And so the points in time where people are most compelled to act are the times where the cost of being wrong is highest and the likelihood of getting it right is lowest. So the odds are just stacked against you. And that's why you build for resiliency, knowing going into it, rather than trying to be smarter in the moment, because it just rarely ever works.
So I always use a metaphor here at Lexington. So we're just outside of Boston. I know you guys are in Chicago, but so we'll probably apply to you. I said, if our portfolio was our automobile, right, and you can only have one car, right? F-350 pickup truck, eats a ton of gas up, paint the park, and so on and so forth. Say a Corvette, a lot of fun in the summertime when you're driving along on a beautiful sunny day, but once you have 2 inches of snow, it doesn't work so well. So we try to build all-wheel drive vehicles here, right? Four-wheel drive cars. I'm not going to name the brand. There's a lot of them out there. So maybe it's not the huge F450 or 350, maybe it's not the sports car, it's something in between that's going to work for our median weather, which could be 1.5 feet of snow, or it could be 100 degrees, right? So I think we do some version of that in what we do in terms of creating portfolios for clients. So we, with your help, about 1.5 years ago, things were coming along quite nicely. And we had our portfolios built. And we build them a little differently for every client, but we had certain themes expressed. We made some pretty decent changes about 1.5 years ago in fixed income and in real assets. Can you discuss what we did and why?
Yeah, coming into the year, we mentioned a couple of things, right? We put out that paper on fixed income complacency. We knew inflation was here in 2021. But we talked about inflation would be persistent, but it wouldn't be the exact same inflation. If you remember inflation in 2021, there was a comment like used car sales were up 50% year over year. So we thought inflation would persist, but it would change in the way that it was manifesting in the economy. It would come through shelter or owner's equivalent rent and CPI, which is how they calculate it, or basically housing prices. It could come through energy. It could come through food. And so one of the recommendations was to not only increase exposure to things that can benefit from inflation, but also broaden that exposure out. Because the last thing we want to do is believe that inflation is coming, that it's going to be an issue, but then take one singular bet, and that's just the wrong bet, and we miss the inflation trade, right? So broadening exposure to inflation, and that was kind of a key coming into the year. The second is, if inflation is here and it is persistent, the Fed is going to have to act. That is going to influence our fixed income portfolios. So what do we do about that? So we introduced dynamic bonds, made an allocation there that reduced our exposure to just interest rate volatility, which is the most important thing when talking about the Fed increasing interest rates. So that reduced some of that volatility, certainly has drawn down much less than fixed income in this environment. I appreciate that being down 1 or 2% on dynamic bonds versus 7, 8, 10, 12, depending on where the ag is, that's kind of winning by losing less, but being down 2 versus being down 10 is certainly a pretty big difference there. And so increasing that allocation and introducing the allocation was important kind of coming into this year. Now, it's easy to sit here kind of Monday morning quarterback style, look back and say, yeah, we should have been in cash. We should have only owned real assets. We should have only owned dynamic bonds. Why do I own anything with duration risk at all? Again, getting back to that idea of resiliency, I could pretty easily paint a picture that something like Fed raises 75 bips today, they've got to go hard in September, inflation print next month keeps going up, we enter a recession, rates actually fall, people start buying more bonds, and that part of your portfolio that's been down so much is now the protection element, right? I'm not saying that is our prediction, but when you think about the myriad of ways the market could go, the fingers in different directions that it could spread, at periods like this, where we have a regime shift on what the Fed is doing, from quantitative tightening, from a geopolitical perspective. We used to be in a globalized economy. Now we're in kind of a regionalized economies with the West and the East, kind of NATO and Asia. And so those can create very different fingers and directions markets go. So we're always going to lean into opportunities and lean away from risks, but never kind of bet the farm, because if you're right 60% of the time of investing, you're kind of in the Hall of Fame. And so we want to have humility in those decisions, and again, build for that resiliency throughout. So those changes have absolutely made a benefit year to date.
I agree, adding real assets as well. When we added real assets, essentially that money was coming out of long equities, right? When at a time when long equities were really running, right? Yeah. So, the real assets did fine during that period, but not as well as long equities. And then this year, with equities taking a hit, real assets have really shown. But it's, I guess, diversification. I think Winston Churchill had a quote that democracy is the worst form of government, with a pause, except for every other. And I think diversification is the worst form of investing, except for every other, right? I just think it's the case. So why we're talking about diversification, equities, international and emerging markets. We've been diversified into them for some time. And in the 2000 and 2008, they were wonderful diversifiers and return enhancers. And then they kind of went to sleep for a decade while the US really ran. And we had some exposure to them. From where we sit today going forward, some clients ask, why bother with international and emerging markets going forward? I can just invest in US multinationals, I'll get my exposure there. You've probably heard all these arguments before, I know you have. Should we bother diversifying into international and emerging markets? Just your take at that.
Yeah, it's a very fair question, right? Looking in the rearview mirror, you can say, oh man, S&P was the only game in town. And really coming out of the GFC in 2009, and Ben Bernanke was at the helm at that time, right? Took interest rates very low, was the first country to introduce this new idea called quantitative easing. And kind of the US shot out like a rocket. The dollar has strengthened materially above most major currencies. So if you own $10 of something outside of the US, and it doesn't change at all in price, but the dollar goes up 2%. When you bring that money back, you've only got $8 worth, right? So the dollar has been a major headwind outside of the U.S. For investments outside of the U.S. And frankly, again, that narrative of where did we come out of the GFC? Minimum economic growth or minimal economic growth, very low volatility, and maximum liquidity. Kind of the US was poised to take advantage of that, given our weights in technology, given our weights in healthcare, relative to other industries outside of the world. Now, if we pause and talk about kind of the world we're in and the world we're going into, right? Rising interest rates, what persistent inflation can mean. looking at the NASDAQ relative to the S&P, for example, year to date, the NASDAQ is down 30%. These are rough numbers. NASDAQ is down 30, the S&P is down 20, EM's down 12. Still down quite a bit, but don't get me wrong. There's a pretty big difference there between the NASDAQ, which is the belle of the ball, and down 12. And then if you look at value versus growth, the spreads there are upwards of 20%, depending on large cap or US or small cap, et cetera. So those are all precursors to what continues to make international an attractive space to be. There are markets and economies that are exposed to more of these things that we're looking for exposure to. Brazil is their market is doing really well this year because they're very exposed to the energy market, and the energy market is robust, right? So that's building diversification. And then, so that's kind of at the today or 1,000, 10,000 foot level. At the 30,000 foot level, when we just think about, well, why would I own anything outside of the United States? I don't get it. We're the bright spot. We are the world's largest economy, but at the world's largest economy, we're 34% of the global GDP, right? 2/3 of GDP still lives outside of the United States. The vast majority of securities that are traded in our markets are outside of the United States. The world's second largest economy, China, with far higher economic growth, a population that's 10x the size of the United States, right? All of those elements still live outside our borders. And so to think that just kind of New York to California, this is the only place where good investments live, would be a fairly narrow view in our mind. And so when we go hunting for the best opportunities, we really want to do so with the biggest opportunity set. And that opportunity set to us remains global.
I have a question that just came in. It was talking about low investor sentiment right now. And I'll make a comment before I go over to you. I was reading something yesterday, University of Michigan, when they looked back at investor sentiment, when it was the most negative, the following 12 months returns were much higher than when they were most positive. So when there were positive sentiments, future returns were lower. And when sentiment got really negative, it was positive. I guess going back to the Warren Buffett quote, when everyone gets fearful, it's time to get greedy. When everyone gets greedy, it's time to get fearful. That said, your comments, what are your thoughts around sentiment as of now?
I mean, Liz Ann Sanders just said, though, that fear and greed aren't an investing strategy. But no, I get what you're saying.
I mix my metaphors.
Yeah, exactly. I think the couple of things to unpack there, right, is so sentiment is an attempt to gauge market emotion. It's an imprecise thing to do. You can do it through the Michigan Sentiment Index. You can do it through flows in capital. You can do it through surveys. Like there's a couple ways to do it. So I'd say first off, the precision of sentiment is modest. Mm-hmm. But if you just take the logical conclusion of like when investor sentiment is worst, usually that's when things are bad. Historically, that's been during a recession. It's been when unemployment is high, when portfolios are down, people losing their jobs or could be losing their homes, right? Those are gloomy times, and prices normally reflect the gloom in those scenarios. Mm-hmm. Same thing, dot-com bubble, 2007, when things are just humming and you can kind of make money hand over fist, that idea, sentiment is high, right? So that also is reflected in price. And so, euphoria does tend to be related, if not correlated, to price. And that gets back to valuations, that over a reasonable period going forward, if you look at just buying when things look the darkest or when things are the cheapest, those tend to be far more successful strategies than trying to buy when things feel the best and you just continue to run. Now, as a predictor, right, on, today sentiment is low, like now's the time. Same thing with valuation. It's not a great predictor in the short term, but it's a great kind of general trend in the long term.
Right. I think many tools in the toolbox, no one is the direct answer. I think it acknowledges behavioral finance a little bit somewhere along the way. Moving forward, let's see, other questions. We got midterm elections coming up. Does that play any role?
Elections are mostly noise. If you look statistically, markets have done the best when the executive branch and the legislative branch are divided. Doesn't matter if it's red or blue on which, it's
Right.
just the fact that they're divided. And that is, markets dislike uncertainty even more than they dislike bad news, because bad news, they can say, okay, I understand it. What does it mean? Okay, I can price it. If I don't understand it, it's an unknown, or it's an unknown unknown, right? Like those things make markets uncomfortable. And so you can actually see in years of midterm elections or general elections, as opposed to all of the years, there is a slight, underperformance in those periods of time. Now, policy ultimately does affect market outcomes in the long term, but when you look at just who gets elected in Pennsylvania, it doesn't tend to be all that predictive, nor does red, blue, or purple, I guess in that instance, tends to be the most beneficial over time.
Okay, maybe one of our last topics, but recession keeps coming up. I know the definition is 2 quarters of negative GDP. And the topic that always comes up is the Fed going to push us into recession? Is it going to be the cause of it? Is there a soft landing even possible? I guess your thoughts around that. And then I'd like to discuss, I think recessions are an inevitable part of our economy, in my opinion, and they just happen. It's a purging system. They personally, from a market perspective, don't frighten me. I think we're usually the canary in the coal mine, the market, and then recession, I'll call it the real economy, happens next, and then a lot of those scenarios, stocks actually do better. Which I don't mean to be insensitive to recession, because it costs a lot of real people a lot of harm.
Yeah.
But I guess if you'll take that one away and give us your thoughts.
So, will the Fed hike us into recession? So the Fed has 2 mandates, price stability and full employment. I would argue over the last couple of decades, they've built in a third implicit mandate, which is keep the markets happy. And so now they've been trying to work on all 3. Well, inflation has not been slowing, and they were late to the party, and that horse is out of the barn. And so the first collateral damage is markets, right? So they'll say, fine, we'll hike, markets are going to pull back, but hopefully we can hike to a point where we slow inflation, but the real economy continues to grow, and markets will be the collateral damage, and that's fine. However, that is largely what we've seen, and we haven't seen a material move down in inflation. The recent CPI numbers is kind of evidence of that. So the Fed now has to prioritize, okay, inflation or real economy, because they can't prioritize them both in today's age with high inflation. Well, the Fed's long-term objective of full employment and basically like happy citizens in a growing productive economy, if inflation's at 9%, and wages at best can grow at, say, 6%, like over the last year, real wage growth, even though you talk about all these employees getting raises and unemployment being so tight, real wage growth is down by 3%. And so the Fed knows over the long term, inflation is the lead objective, and they have to get it under control, but we just haven't had to think about it for 30 years. So the Fed has been willing to say, yep, market is collateral damage, that's fine, we can live with that. Now they're starting to say, does the economy need to be collateral damage? Because even though we've maybe seen some moderation in prices in certain spaces, the labor market remains tight, and the labor market and demand in the economy are highly correlated. And so they might need to break the economy to break inflation. And it seems that they're willing to prioritize that in order to do it. But Mike, to your point, this is not unprecedented. This is exactly what Paul Volcker did in the late 1970s and the early 80s to tame inflation. That also built in a foundation for the next decade of exponential growth in markets and success. And so, these type of things do happen and can happen, but they also sow the seeds for future opportunity. So we don't know what the Fed will do. We don't know if we'll go into recession. The likelihood is certainly higher today than it was before. What we are fairly confident in, though, is that if we enter a recession or as the markets pull back, it does build a better foundation from which to build the next bull market. And bull markets tend to live over time, and bear markets are points in time. And those are the times that we really need to be cognizant and not try to time markets.
You know, Brad, I think I was going to ask you for a concluding comment, but I think you did a great job with that last comment there in terms of, bear markets are a point in time, bull markets are over time. And I think our enduring message to our client is to, revisit your plan, make sure your liquidity profile looks adequate, and then stay the course. And I'm sure along the way, we make some adjustments here and there as we deem fit. But I thank you for your time today. I really appreciate it. It's probably coming up on lunchtime, Chicago time. So enjoy your lunch. And I am very thankful for your time today.
All right. Appreciate it. Thanks so much, Mike.
Take care.